Good afternoon, everybody, and welcome to the second in this series of webinars on global interest rates and the implications for fixed interest investing. This is an opportunity for us to examine the direction of rates and as importantly, the way in which that's feeding through to the range of fixed interest investments that are offered to retail and wholesale investors. Robert Moore, the head of fixed income from JANA, will again be our moderator today. So welcome, Robert. But we're joined today by Adam Roberts from Australian Integral and Frank Danieli from MA Financial. But before I hand over to Robert to host today's webinar, let me just talk a little about some of our upcoming events for the rest of the year. Advice in Action is our opportunity to talk about the way advice businesses are evolving. We'll be focusing on high net worth clients and the processes and requirements to give advice to them. And I met this morning with the chairman of a billion-dollar family office who will be speaking at Advice in Action about the client's perspective, the billion-dollar client's perspective, on what they expect from an advice firm. So we have a really interesting set of sessions for Advice in Action, and I'd encourage you to join us in July. In September, we'll be hosting an afternoon session for Sydney Alternatives Week on alternatives and discretionary portfolio management. Again, it continues our theme of the opportunities that a high net wealth client base give rise to, and the best ways, in fact, of serving that client base. Then in October, Independent Thought, our Portfolio Managers Conference. And in November, a new event for us. There's been a lot of focus on MDAs as a result, in part, of the reissue of the MDA instrument, which is due to be launched by ASIC in late September or October. And so in November, we'll be hosting a conference, a symposium on MDAs and the opportunities that they hold for advisors and portfolio managers. But between now and then in the MDA space, we'll be running a set of workshops on responsible manager masterclasses, on risk management for MDAs, and on best practice advice for the creation of advice around MDAs. So if that's an area that's of relevance or interest to you, I'd encourage you to join us in any one of those events. This week is also pretty much the final week for submissions to the IMAP Managed Account Awards. We already have quite a number of entries, and if this is an area of interest to you, to showcase what you think the value you add as a portfolio manager or as a licensor, I'd encourage you to enter the Managed Account Awards. The other thing, of course, which we welcome is questions. Ask a question through the Q&A button, and then the panel will see that. So now it's my pleasure to hand over to Robert Moore from JANA to host today's session on global rates and the opportunities they give rise to in fixed income investing. Robert, thanks very much.
Thanks very much, Toby, for that introduction. Look, this is the second in the series. We heard yesterday about the potentially deteriorating macro backdrop. The Iran conflict and the oil price shock has certainly turned out to be less transitory than a lot thought, and certainly a lot of the managers were telling us initially it was going to be very short. And it's no doubt, that shock is hitting headline prices such as fuel so far, but there's potentially secondary impacts to come. And bond markets are certainly very volatile, and rates look set to be structurally higher, possibly for at least a while. So this session, we're going to turn to credit, the return generating part of fixed income, and what that environment means for credit. Is the inflation maybe a tax on growth and things slow down and central banks outside of the RBA, of course, possibly stand pat and look maybe even to eventually ease rates if the environment is really negative for growth. And that could be a positive environment for credit, but equally inflation could well be a problem. The RBA certainly is worried about inflation expectations becoming unhinged, and they could have to slam on the brakes, and other central banks slam on the brakes, and rates go a lot higher, and that would be a structural headwind for credit. So these are the issues for our near future. But right here and now, economic activity is still quite strong, and it's certainly well away from recession levels. And company earnings are really positive and surprising to the top side, and balance sheets are sound. So outside that macro story, and despite strong earnings and relatively low defaults still, credit markets have been in the headlines a lot in a very negative way over the past 6 months, from high-profile defaults, delightfully termed cockroaches by Jamie Dimon at JP Morgan. We've also seen fraud-related losses. We've seen an increased regulatory focus on issues such as governance and valuation in certain sectors, like private credit, and look, the ASIC review paper is very notable. And more recently, there's been almost hourly headlines about wealth investors in private credit vehicles, suffering losses and being gated and from redeeming. So, it's been a really intensive, focused period for credit. We've written here at JANA research notes on these topics, short form and long form notes. But honestly, it's been a bit of a whack-a-mole process, because every second day credit's in the headlines. So we're speaking to two really experienced credit professionals. So it's a great chance to speak to the people at the coalface here and look at what's going on in credit, and also look at the opportunities for income from different credit sectors. And taking some of these current themes into account. We're going to look at what sectors are attractive and how do we think about the risk return environment for credit. So at the very start, we're going to Frank from MA Financial. So I'll hand over to Frank now.
Thanks, Robert. For those of you who don't know me, I'm Frank Danieli, Head of Global Credit Solutions at MA Financial Group. We manage about $14 billion in credit, $7 billion in our non-bank platforms, and about $7 billion in our private credit suite. What I wanted to talk through, you'll see some slides shared shortly, was something that's been a very important thematic focus for us, which is what private credit really means. As Robert said, it's been all over the headlines. But I think private credit itself actually has a little bit of a definitional problem. And we've been writing about this recently. So I'm going to take you through the theme of our latest quarterly investor letter and what that really means for the sector, but more importantly, what it means for you as allocators in thinking about an allocation to this asset class within your clients' portfolios. Private credit done well is a very interesting asset class. In essence, what it is looking for lending opportunities where banks are not, or for some reason they're no longer, the efficient provider of capital. Now, why can this happen? Well, this can be driven by regulation. Banks are heavily prudentially regulated institutions, and so regulation can make certain types of lending not efficient for them to do. There can be changes in market structure. It could be borrower requirements around need for flexibility, customization, speed, certainty, and technology can also play a role. That's the best of private credit. It's trying to find those rivers of gold where banks, for whatever reason, are not the right lender, and then providing a real-world lending solution. Of course, it could also just be things that are way too risky for a bank to ever want to do. And what really matters is knowing where in the spectrum you're actually playing. And the thing about lending is that we like to say, we're not in the business of picking winners. We're in the business in credit, whether you're public or private credit, of avoiding losers. You are basically doing lending in simple terms. And that means you're going out, putting money at work. You want that money to be paid back to you on contractual terms. for your interest to be paid to you along the way, and you want the chance that you lose money to be very low in that one loan. And of course, in a well-diversified and well-structured portfolio, you want that to be balanced overall. This is all about consistency. It's about the defensive part of someone's portfolio. And to do that well, you need to be in a range of different subsectors of lending, just like banks have done for hundreds of years. The problem in private credit is that globally, this term has come to actually mean just one thing. It's come to mean sponsor-backed direct lending, which again, in basic English, we love jargon in our industry. In basic English, that is providing loans to help private equity companies buy other companies. That's a perfectly legitimate activity, but it's actually a very small part of the total private sector debt universe. You can see that on the left here. I've got some data that says, well, if you look at the total private sector debt, what component is this sponsor lending? Sometimes that's called leverage finance, sponsor lending, doesn't matter. Private equity buyout funding using loans. What's that? Well, that's actually about 10, 15% of total lending. But it's actually 100% of the mandates of many funds doing private credit globally. In Australia, the dynamic is a little bit different, where many funds are set up to only do real estate credits. You have managers that only do, say, direct real estate or direct real estate construction financing. It's not that there's anything good or bad about those sectors, sponsor-backed real estate, any other part of lending. It's just that there are many parts of a broader universe. When we look across the Australian private credit spectrum, certainly the part we play across, there's about 38 different credit subsectors that we're participating in. Sponsor-backed direct lending is part of that. You can lend to normal, non-sponsor companies. You can lend directly against assets. You can do something called asset-backed lending, which is basically where you partner up with banks and you provide financing with non-bank and specialty lenders to real-world portfolios of loans. And I say real world, like home loans, car loans, business loans, equipment and asset finance. This is the total spectrum of private credit. And we need to redefine what we mean by this asset class. Now, why this is really important is that as this sector has grown from 26 years ago, a $50 billion asset class globally, to a $3 trillion US dollar asset class today and continuing to grow. If you have more capital in the sector, but managers are set up to only do one small part of it, then at some point, just the natural course of a market cycle is that at some point, the risk-adjusted returns in that part of the market are no longer as attractive. And that's just because things go up and down, natural part of cycles. But if you can only do one thing as a lender, and especially as a fund manager, what do you do when that part of the market becomes less attractive? You're going to call up your clients and say, hey, take the money back. We don't want it anymore. Go deploy it elsewhere. Of course not. That's not your incentive. Your incentive is to continue to participate, to, of course, earn fees and manage your activities. So you keep lending. So then you keep lending, and then you have to start trading things off in order to win deals. First, you give up pricing. So you see spread compression. Then after you've given up price, you can't do that anymore. You have to give something else up. So you start giving up terms. The protections of being a lender, things like covenants. That's how you see in some parts of the global sponsor-backed market, 85% covenant-led lending. Finally, when you've given up all your covenants, not much more to do. You start giving up some of the sacred rights, the structural protections of lending. Principles like for debt to lose, equity needs to lose first. And so you have these weird things like liability management exercises. But the problem is not those things having occurred. It's the incentive problem of people setting themselves up to be monoline and only to do one thing. And that's really what's all in the press around private credit. It's manifesting itself in this concept that many private credit funds globally, in particular, these things called BDCs, which is more jargon in the sector, but basically private credit funds in the US of a certain kind, having way too much exposure to software and technology borrowers that are sponsor-backed. BDCs, on some stats here, like these are Barclays statistics, have 22% exposure to that particular cohort of lending. Now, the reason this occurred is because after everyone gave up price, gave up terms, gave up their structural protections, they said, well, if we've done all of that, our documents are a bit weak. What do? Well, we better only lend to quality. And so software and technology borrowers are actually, in theory, quite high quality. They are recurring revenue, subscription based earnings, high margin, cash generating system of record businesses with high valuation. So you've got a bigger equity margin of safety. It actually sounds pretty good in concept. And then lo and behold, AI comes. People are wondering about the sustainability of these borrowers. The problem is not that there were loans made to software and technology borrowers. The problem is the concentration of it, driven by the fact that people were swimming or fishing in a small pond. It's okay to have exposure to software, it just needs to be balanced because we're in the business of lending, diversification, and non-correlated returns. And that's really what needs to happen in this industry of private credit. We need to evolve the definition of what it means. It needs to mean lending outside of a bank balance sheet or the bond markets. It needs to reflect a fixed income alternative, a substitute for fixed income. Yes, with some degree of lower liquidity, but with a premium return in exchange. And so that's why we need to move away from things like what I'm showing you here on the slide, which is this talk in the past of, private credit's great for your portfolio because it can earn equity-like returns through the debt. This analysis goes over about a 20-year period and says, well, what did private credit deliver in terms of annualized returns, which is the y-axis on the left? And what was its volatility profile, the x-axis below. And it basically says, well, private credit delivered you returns more commensurate with equities, higher than what you get in bonds or high yield bonds, but with lower levels of volatility. This idea of equity-like returns through the debt, this is not the way we should be thinking about private credit. We should be thinking about private credit like this. We should be thinking about it as a spectrum, just like you do in traditional fixed income. Traditional fixed income, you've got investment grade bonds, high yield bonds, more return but more risk. And then you have things that are opportunistic or higher yield in nature, and they're going to be even higher return but with more risk, with a higher risk profile. And it's a spectrum. And the same thing is true in the private markets in private credit. There is investment grade private credit, there is high yield private credit, and there's things that are opportunistic and high risk. The premium that you need to get in private credit should come from the fact that there's less liquidity and from the fact that these are proprietary assets. You can't just go and get them on, by opening a Bloomberg and buying them. And so that's what was coming from the premium. And therefore, your investment allocation decision is to say how much of the defensive allocation in my portfolio, traditionally in bonds, can I trade off some degree of liquidity in order to capture this return premium, hopefully on a risk equivalent basis. We need to shift the paradigm of thinking. And we can only do this if we change that way of thinking, but also if we have the right disclosure and we give you as allocators the right information to make that decision. And that's where the industry needs to further evolve, which is it needs to really evolve around what we do on disclosure and transparency. Disclosure and transparency needs to be more than just telling people what's in the fund. That's a basic level of hygiene. That it's diversified, what the actual sector types are, the characteristics of the loans, the features of those loans. But we also need to disclose the risk-adjusted return, where it's coming from. How is the return being generated? What are the performance characteristics of the portfolios, the key lending metrics, the drivers of return, and yes, of course, is there leverage or not, and what is the profile of that leverage to deliver the returns being generated? And then finally, credit, as I said, it's a business of avoiding losers, not picking winners. So having the right structures and governance is as important as choosing the right loans and managing your portfolio well. We need to have good disclosure and transparency about how we're doing those things, how governance works. Are there the right segregations of duties? Are there independent reviews, evaluations, ratings, processes? Is there transparency on fees? And if we do all of these things at that granular level, then we can give people the right tools to decide, where do I want to be on the risk spectrum? What parts of the credit market do I want to be participating in for my clients? And actually then match objectives with what is delivered. We don't want situations where two funds look ostensibly the same from a net return perspective, but they have vastly different performance and credit characteristics, but people can't tell. The important thing is that people know. And so therefore the questions for you as allocators are, do you have that visibility to make that independent assessment? are you actually getting a proper private market premium? Is that compensating you sufficiently above what you get from a listed market alternative or a liquid alternative? And then finally, can you trust the manager as an empowered fiduciary to be aligned with you in making those decisions with proper and rigorous governance? If you can't answer these things, I think the answer, the right action is don't allocate. If you can, then you can see where they fit within portfolios. And so this is really where we see, as a manager in the space, the industry needs to get to. And I think there's some really good practices in the space, and there's some practices that need to evolve. With that, I might pass back to you, Robert, and I'm sure later there'll be plenty of questions.
Yep, I'm noting them down already, Frank. So get ready. It's an interesting topic. Some great insights there. Really appreciate that. We will come back to you, but for now, I'll turn over to Adam from Australian Ethical. Over to you, Adam.
Excellent. Thank you, Robert. Thank you, Frank. Toby, do the slides come up on the screen?
Do you want me to share from here, Adam?
Yeah, that would be great. Thank you. And so maybe while they're coming up for everybody's background, maybe when we think about how we approach the space from Australian Ethical, stepping back a few years ago, private credit's obviously an important part of a model portfolio. It's important to have exposure. But when we were thinking about our ethics, our morals, where we wanted to invest our capital, as well as the risk-adjusted returns that we were seeking, we were sort of led to infrastructure debt for a lot of reasons. And if we click across to the next slide, and perhaps one more, Toby. There's a few sort of pretty key characteristics when we think about infrastructure debt. So we like the idea that we're lending to specific projects and taking security over specific projects, rather than lending to corporates where there might be other lenders there, and you have to work out how you rank across a capital stack. We really like the fact that these assets generate a lot of high cash flow, and so you're helping contribute to build capital intensive projects. You put them in the ground. It's not easy to move these things if you get them wrong, but once you've lent towards a project that delivers a high yield, you've actually got a lot of income that can service your loans. And the last piece is, because you're lending to specific projects, some of the points that Frank made earlier around covenants are really important here. You've got a lot of visibility and predictability about your cash flows. And by doing so, it means that you're able to look at where income will come from into the future. And these assets, from a predictable cash flow perspective, mean that you're able to pay down your debt through time, rather than be somewhat subjective to how businesses are performing in the market. And so if we flick to the next slide, when we think about infrastructure lending, we're focused on sort of three main sectors. So the first being renewables, and we'll talk about this in a bit more detail later on, but there's obviously a big capital need to meet our net zero goals. And these renewables assets are the lowest cost of energy generation, regardless of how you think about modelling pricing and whatnot. There's a predictable level of generation that comes out of these assets and a predictable level of cash flow. The second area that we focus on is social infrastructure, and these tend to be assets that have a moat. There is a critical need for them in the economy, and they tend to operate very resiliently through good times and less good times. And then the third sector that we focus on, which is more of an evolving sector, and it's evolving due to sort of changing regulatory frameworks, cost of living pressures, etc. But we'll call it sort of asset-backed property with sort of infrastructure-like characteristics. And what we mean through this sector, it's things like social and affordable housing, where there might be some sort of government cash flow or some sort of regulatory framework that provides certainty or visibility over the cash flows into the future. And so then if we flick to the next slide, what are some of the benefits that we talk about here? I think I sort of already mentioned government support, but there is a implicit or explicit level of government support that sits around a lot of these assets, and so you know that there is either a protection around demand, there is something from a supply demand imbalance that makes these assets attractive assets in the community, or there's an explicit regulatory angle to them that regulates their cash flows. The second is there is, as I talked about, a high level of income that comes off these assets because you need to earn a return on your capital and a return of your capital in these assets. You're able to amortize the loans down through a lot of cash flow during your lending period. When you want to express a level of sustainability in your investing, I think this is a very attractive way to do it from both a social infrastructure as well as a climate infrastructure perspective. And then when we talk about in a second the ability to get diversification from some of those other sectors, this is it's a sector that's been around for a long time. It's typically been focused on by the banks, but as more and more some of the regulatory changes come through, as well as just the market for infrastructure debt increases, there becomes more and more of a role for private credit to play. One of the points I was trying to make earlier was just around the predictability of cash flows, and we've just got two sort of made up examples here. But along the top, the little pictures trying to show that an infrastructure loan has a lot of income generation, and most of the need that you come through from an income perspective is a high EBITDA margin or a high variable amount of revenue. And then the reason for that being that you need to earn that return on capital and return of capital, which means that when you've got a high margin, you then have a lot of cash flow that can service your debt, and there is a level of predictability that comes through those earnings. If you want to compare it to how corporate credit works, there'll be more variability in those cash flows. There'll be some good years, there'll be some less good years. It might be more focused on how the broader market's participating. And in doing so, you'll have some periods where you might have a lower operating margin and therefore a skinnier ability to service your debt. So when we're thinking about protection in a capital stack, we really like the fact that these assets have high cash generation. And in doing so means there's a lot of cash that's able to come and pay down your debt, and you obviously rank as a priority in the capital structure. And Frank had sort of a similar picture to this, but when we sort of map out the risk return profiles across the spectrum, what we can see is that infrastructure debt is actually placed in a similar position to bank hybrids in terms of return and volatility that's been achieved in that space. And so when we're thinking about what's a natural substitute as sort of the big wall of capital rolls out of bank hybrids into the future, we think of infrastructure debt as an attractive place to park that capital. And so you don't necessarily have to take my word for it, but there's been a lot of analysis that's been done over the years around defaults and recovery rates. And what you see, especially once you get past years 2 and 3 in these loans, is there's very low default rates. And part of the reason for that is that these assets then have stable and predictable cash flows, which you're lending against as part of your investment. I might just flick through this just in the interests of time. But what I wanted to touch on briefly was renewables lending and the energy transition opportunity. And we're at about 50% now, a little bit shy of 50% in terms of renewable generation as part of our energy mix. But we have targets of getting to 80% plus by 2030, and the amount of capital that's been spent in this space to date is about $35 to $40 billion. We've got 33 here on the page, and so that's the first. We've spent, let's call it $33 billion to do the first half of the transition. That's been the easiest half in terms of focusing on the lowest cost projects to get to sort of 50% penetration. To do the next 50%, it's going to cost roughly double that. So there's another $80 billion that's required to get us there. And as everybody knows, these projects are a mix of debt and they're a mix of equity. roughly 50% leverage in these projects. And so there is therefore an opportunity to do sort of $40 billion worth of lending into this space over the next few years in order to meet the opportunity. Now, why is that very attractive? Obviously, the big banks participate very actively in this space, and when they're providing capital, it's at very attractive rates. But the problem is that not every project neatly fits inside the credit envelope of a bank. Quite often, it might be that some of the projects are just too small. So lots of the banks don't get out of bed for lending under $200, $300 million in this space, just in terms of the effort to reward, of understanding the projects, economics to them on syndication, etc. And so we actually really see it as playing in the mid-market in this space being really attractive, and you're able to earn outsized returns as a result. And so just to sort of illustrate this a little bit, the reason that we find it very interesting to lend to these renewable projects is these are long dated projects. They'll be around for 30, 35 years. And when the cash flow is coming out of a renewables project, as a lender, you're receiving your interest as well as the pay down of your principal first. And so you can look at various cases for what happens if an energy price is $25, $75, $100, etc. But the way that you size these projects is to make sure that you're being repaid in the first few years of the project. And then you have a number of protections in place, for example, covenants or lockups or cash sweeps, which means that if there's any sort of underperformance in any way, you're taking an outsized share of all of the cash flow in order to pay down and de-lever your loans. And then when you think about that point that Frank made in terms of achieving equity-like returns from a lending perspective, I think we'll very much echo that that comment in the fact that you should get the right risk-adjusted return for the risk that you're taking here. And when we think about renewables projects, we probably see this as a 3 to 350 point spread to the cash rate in terms of what you should be delivering on a net basis in this space. Now, these projects should probably achieve a 10 or 12% equity return, and they should probably achieve a 7 to 9% debt return when you factor in some of the sort of time value of money around the lending. And so I think one of the biggest traps to be mindful of is if something's too good to be true, chances are it is. You're either taking the wrong risk, or the risk has been mispriced, or sometimes there might not just be enough money in the transaction in order to deliver the return that you've been promised. And so when you think about these renewables type projects, you should be looking to achieve a sort of mid to high single digit return for the risk that you're taking on. When we talk about diversity earlier, there's probably a world of 400 to 500 type projects across Australia that you can invest in this space. We will be selective. There'll be certain areas that we won't participate in as Australian Ethical, but even still, just given the subject matter and the types of projects that exist here, I think they've got a strong social or environmental angle, and we see a big deep pool that we can achieve diversity within an infrastructure debt asset class. And so maybe we put it into practice. What does that all mean? So when we think about achieving diversity, we've sort of got nearly 50 underlying projects that we lend to across sort of more than 20 loans. We want to be as nearly 100% senior debt in all cases. Our portfolio currently is 100% senior debt today, and we want to achieve that diversity of asset class as well. So even within renewables, you want to have a mix of wind, you want to have a mix of solar, you want to have a mix of batteries. And then when you think about some of those social asset classes, you want to think about achieving that diversity as well. And so another thing obviously to be mindful of in these types of assets is how exposed you are to changes in interest rates, especially when we've been through environments where you've had relatively rapid changes in interest rates, and you want to make sure that you've got the right protections in place to either see that hedged or to be sort of passed through on a floating or a variable rate from a borrower's perspective. where have we been landing on this for the last few years? So we've been achieving just north of 300 over. So that ends up being about a total return, in the sevens, high sevens. We think that's quite attractive for the risk that you're taking on. And what is the risk that you're taking on here? It's largely illiquidity premium that you should be seeking, and being paid for being deployed. But when we think across the market and you see how that stacks up against some corporate credit, when you think that stands up against ABS and the like, we think that's a pretty attractive place to be, delivering north of 300 into infrastructure assets. And then I'll just finish quickly just by trying to bring, what it actually means to life. So this is an example of an operating portfolio that we've lent against. So there's obviously predictability in the cash flows. You've had many years of operating actuals that have been achieved that you're able to then forecast into the future around. And the idea here was that we want to be sort of deeply in the mid-market of this space where you've got lenders that might not be able to find a bank solution, or they want to do something that's a little bit out of left field. It's not so much about the risk that you're taking on, but it might be about the structuring. And so here, this was a loan that allowed, it was a portfolio that was not geared. It didn't have any debt against it today, but they wanted to create some additional capacity to buy some extra assets. So we lent against their existing portfolio, and that freed up some capital that they could buy some additional operating assets. And we often see that across the universe, where you might have a solar farm or a wind farm and has low levels of leverage against it, but somebody wants to free up some capital in order to build a battery, which helps sort of future-proof the variability of energy generation. That's actually a really neat thing as a lender to see in the market, because it really firms up the ability to deliver your revenue stream. So we often will lend to those projects where that capital doesn't just come off the table; it gets used to build a battery that's co-located at these renewables projects. And in doing so, we then have security over a larger asset with more diversification in its revenue stream. A different example, and this is this isn't a core part of a portfolio, but this is another way to tackle the energy transition is lending to electric vehicle chargers. And so EV's the largest publicly available charging network in Australia. We lent to provide them a growth facility. So lending against the existing income that comes out of all of their charges across Australia, as well as a facility that they could draw down onto to accelerate their deployment into new areas. And so new facilities need to meet certain criteria. They need to have a certain cost element to them. They need to be forecast to deliver a certain amount of revenue, and then that all gets put into the portfolio, and our security is over the sort of the larger pool of assets. And so this is something that you're not expecting to do 100% of your lending into, but it's a very nice way to sort of support the energy transition outside of just typical solar and storage assets. And then finally, lending to battery projects is all the rage in recent times, and the reason being that they've got a natural place in the energy transition. There is a defensibility around batteries. They're able to be charged up in periods of excess generation. So typically the middle of the day when the sun is shining and everybody's at work. And then that energy is able to be put back into the grid at periods of high demand. So think about it as everybody's making their dinner or watching television in the evening when the sun's no longer shining. And so by lending to these projects, you're not having to take a long-term view around, well, what do energy prices look like? You need to take a view that these will charge and discharge at certain intervals and deliver a certain amount of revenue to you that you then use to pay down your debt. And so that's an example, I guess, of sort of a diversified portfolio of these assets. We really like the risk-adjusted return that comes through. There's also a social and environmental positive that comes through the lending to this space. And I think when you line up all of the asset classes, I think everybody will agree that sort of delivering that 3 to 350 return for asset-backed infrastructure assets is a nice place to park your capital. So I'll pause there and pass back to Robert.
Thanks, Adam. That was great. Toby, just turn your camera on when I've run out of time, because there's a number of questions to get through. I'm not sure we're going to get through all of them, but we sort of heard there two ends of the spectrum. And look, forgive me, Frank, you've got a lot in your portfolio. I know it's highly diversified, but we think about it. You know, the main parts of private credit is often thought of as corporate credit, and investors have generally started with corporate credit allocations, and then they've looked for diversification. You know, they've got equities in their portfolios, and then they've got corporate credit in their portfolios. They're very exposed to companies, so they look for diversification, and they go into things like infrastructure, like Adam's talking about, or property, or asset backed. But look, just Frank, great presentation, and yes, terminology is confusing in the space. A lot of people talk about it very differently. You solve some of the issues there, and we're quite clear, but in other aspects, there's still, you know, I've still got some unknowns there about terminology. You know, a lot of people use different terms: middle market lending, direct lending, corporate lending, and in particular, sponsored versus non-sponsored lending. Certainly, on your slide 5, say for direct asset lending, that's termed senior secured, but then corporate lending is senior secured. So can I just get you to cover off, firstly, sponsored versus non-sponsored? What do you mean? And then how is asset lending compared to senior secured, corporate lending compared to asset-backed lending? What are the similarities and differences there?
For sure, yes. Well, look, sponsor and non-sponsor lending are both types of corporate lending. So what you're doing there is you're lending to a company. And ideally, I think you want to be in a senior secured position, which is just like having a first mortgage over an asset or property, except the counterparty you're facing is a business. So therefore, you're thinking about the value of that business and its cash flow generation potential, the revenues it can generate over time, the expenses it has to pay, the cash that falls out the bottom of that business, and you're lending against the enterprise. So you're thinking about the serviceability of my loan based on consistency of cash generation. And second, from a protection perspective, if things don't work out, what's my equity cushion? So if the borrower does default, I can sell the business and get my money back. The difference between sponsor and non-sponsor backed is just who owns it. And a sponsor is a private equity firm, which is generally an institutional style of private borrower. And there's some good things about that, but there's also some challenges with that because they're very sophisticated counterparties. They tend to like to use a lot more leverage than a non-sponsor business. A non-sponsor business might be a business owned by a family, might be just a private company of scale. And these can be quite large. I mean, globally, more than 85% of companies with revenue more than $100 million are private. So there's a lot of private companies out there, and that figure per the RBA is quite consistent, and ASIC is quite consistent in Australia too. So there's a wide spectrum of that. When you're doing asset lending, direct asset lending, what you're lending against, a little bit like what Adam talked about, is you're lending against a physical asset. So Adam was talking about infrastructure, but that could be infrastructure. It could be directly lending against a property. So it could be a piece of real estate, could be a real estate project. And so there you're actually not looking at the cash generation of the physical asset to protect you. You're looking at the value of the asset itself. There are some hybrids. Infrastructure debt's a little bit of a hybrid of the two, probably. And then we have asset-backed lending. Asset-backed lending is where instead of financing one loan to a company or an asset, I'm looking at a portfolio of loans. So let's say a portfolio of 5,000 asset equipment loans, 1,000 home loans, 2,000 car loans. And what I'm doing is usually you're in what's called a securitization warehouse. You're partnering with a bank and you're providing capital to a non-bank lender, not to their business, but for them to be able to go and write loans into the real world, and they're putting equity behind you. But these loans themselves have fundamental protection characteristics in them. Like if they're home loans, they're usually at sensible loan to value ratios and things like that. The asset-backed lending part, the reason that opportunity exists is because banks have scaled back not their participation in sectors, but the way they participate more and more. Rather than being directly in these sectors, they're actually working with institutional parties like us, and we're going in partnership and providing capital into those sectors where there's a specialist operating company doing the day-to-day work.
Perfect. Thanks, Frank. That was a great run through, filled in a lot of gaps. What about Adam in the infrastructure? How do we think about terminology there? Senior secured, is it MES? Is it fixed or floating? Was a question that came up mostly. So can I get you to touch on that, Adam? But also, we've noted here at JANA, infrastructure has been in somewhat of a renaissance lately. There's been a lot of interest in it. Previously, not so much because of that low risk nature you're talking about. It's attractive on a risk adjusted return basis, but it hasn't quite met the yields for some investors. So in your answer after the terminology and the fixed rate part, if you could just cover off on what is happening in infrastructure that it's a renaissance and there's a lot of interest in the space.
Yeah, thank you. And I think the answer to both of those things is somewhat intertwined. And the reason being, I think Frank mentioned this, but private credit is an asset class, and so there are various verticals within it. And even within infrastructure debt or asset-backed lending or corporate credit, there are probably sub-verticals that you can think about as well. And where I'm going with this is that within infrastructure debt, it's just like any of these subsectors, it's important to understand what it is that you're doing, what you're getting, what's on the label. And so you can be a senior secured only piece of debt lending to a particular infrastructure project, and that will receive or should deliver the rate of return that's commensurate with that, probably in line with what I've talked about. You can then go up the risk curve and you can seek additional risk. And you should obviously be rewarded for that, but you should be aware of what it is that you're achieving. And I guess what started to happen in the sector as people, in infrastructure debt as well as some other sectors, is people have chased risk. And so there's other ways that you can be closer to equity by taking on more risk. You might lend as a second or an unsecured piece of capital behind the senior secured debt, but ahead of the equity. And maybe you're trying to deliver 10, 12, 15% returns as a result of doing that. And you can do that opportunistically. It might be that there's a problem, and so somebody that's specialized at sort of fixing situations can provide a piece of debt that's probably highly attractive from a return perspective, but you're taking on a lot of risk. But things like holdco lending or MES lending, there is a place for it in financial markets. I'm not necessarily sure it's a place for retail or wholesale capital to get their exposure, unless you're operating as part of a diversified portfolio like Frank talked about, where you've got a specialist that understands this. And so I think it's really important that people are clear with their language and terminology around what it is that you're investing in. And unless you're coming into a very, very large, super diversified portfolio of everything, where the strategy is diversification is your friend, I think products need to get better at being really clear in what it is that you're offering to your underlying investors, so that there's no conflation between, infrastructure debt, fantastic, really low risk, but all of a sudden you realize that it's actually unsecured holdco lending to speculative developments or whatever it might be. So that's certainly not how we go about it. We want to find that risk adjusted return, but labels and terminology are really important.
Great answer, Adam. Thanks very much. Frank, back to you. We talked yesterday about the bond market and the deteriorating environment with inflation and rates, and certainly RBA started slamming on the brakes. And there is talk we might be having to have the recession we have to have. Firstly, what's the outlook for private credit given the potential for that deteriorating environment, and equally, what can investors do about it? You've got a slide in there that mentions that a manager's unlikely to hand back the capital if the risk-adjusted return isn't great. But equally, the assets themselves in a fund are illiquid, there's not a lot of rotation you can often do in this space. So should investors just ride out the cycles, or how do they think about private credit in the current environment?
Yeah, I think that's the reason why for investors in private credit, broad-based diversification, I think, is a real advantage that allows you to rotate your book between different sectors as a manager, depending on where you see the best marginal dollar, but also to be able to honestly assess where you need to de-weight things. So, like, for example, we've de-weighted by half our participation in direct asset lending within Australia over the past 18 or 24 months because the environment for that type of particularly real estate credit has been more competitive and more difficult. Whereas we've found some really good asset-backed opportunities in both Australia and globally, and we've actually leaned in there. So it's not that there's no good opportunities, but it's that the dynamics of different sectors shift over time. I think to your point about a recession, look, the answer on whether we're going to have a recession coming is I don't know, but I don't need to know to do credit well. The way we approach credit is to take this approach we call what you have to believe, and we do that at every loan. Then we aggregate it up. And this is basically saying when we make a loan, we want to know where that loan breaks. I think for investors or allocators, that's the first flag, green or red, which is if a manager can't tell you where their portfolio breaks, they actually can't tell you what the stress testing looks like. Either they don't know or they're deluding themselves because and maybe they're lying or deluding, and it probably is worse if they're actually deluding themselves because you can always lose in any position, any credit, any loan. CBA will have loans at default today, and some of them probably lose money. You want to know what it looks like in aggregate. You want to balance the downside and be prepared to roll up your sleeves if times get tough. So what I'd suggest allocators ask managers is not so much do you think there's a recession coming, how are you placed, but rather when a recession happens, we don't know when, but when it does, how's your portfolio going to fare? What's your latest stress testing? Can you show me that stress testing? If they can't show you, then that's a red flag. And it's a red flag because look, banks, people say all sorts of nonsense in this sector, like, oh, we're under NDA, I can't tell you, it's proprietary, it's completely nonsense. The banks put out this kind of stress testing and disclosure because the regulators require them to, and we should be doing it too. And that then helps investors to assess not only what's the profile and characteristics today of this fund, but how's it going to go? And am I happy with what I'm getting compensated for now, given the downside risk that inevitably exists if you go through a bit more of a volatile time? Well, your point on liquidity, look, I just think these markets will converge. There's listed structures, listed investment trusts, listed notes now. If you're in an unlisted fund, you can have contingent liquidity on a periodic basis, but ultimately you have to look at the duration of the underlying assets. If they're 12 months, 24 months, or 5 years, if everyone asks for their money back, you're going to have to wait for the assets to perform. But you can look at some of those listed structures and they'll have different dynamics that are at play there. You'll have pricing daily versus valuation, and that can be good and bad depending on the environment.
Thanks, Frank. Great answer to such a topic. The liquidity, we might get to it in a sec. Another big theme, Adam, you touched on it in your presentation, is AI. We already had an energy challenge in Australia with shifting over to renewables, so there was already, a rush to invest in generation, and along comes AI and data centers needing gigawatts and more. On the one hand, you could think this is a great opportunity, great time to invest, but equally things are happening at the speed of light. Is there risk here that there's just money misspent, misallocated, or built poorly, and investors should be aware of what's going on here? What's your view?
Yeah, absolutely. I think it's probably worth people thinking about the analogy. Just taking a data center. There's no point having a data center in the middle of nowhere with no tenants, and so even if you've only lent 40%, 30% to that asset, if it doesn't have residual value, there's either no income or you can't sell it to somebody else to pay back your loan. It's not going to be a good investment. And I think there's a lot of good that comes from the AI boom. There's a lot of capital that's going to be needed. It's just really important that it's thought through in terms of whether it's equity or whether it's debt going into the space. We've participated on both the equity side and the lending side, not into the same opportunities, of course. But when you're thinking about anything AI related, you probably need to have the same lens regardless of what side that you're playing it on. You need to understand, well, these is highly capital intensive businesses. How long are they going to be around for? What is the payback period? What are the risks that you're taking on? And I think the people that are doing it very well are the ones that are saying, I'm very happy to take exposure to this. I'm very happy to lend to these projects, but I need to see certain things before my money goes out the door. I need to see all of the development approvals. I need to make sure you're able to build this thing. I also need to make sure that you have a solid book of tenants. And so typically you'll see lots of capital going into what they call hyperscale data centers, which means that you've got just a few core tenants. They could be Microsoft, Facebook, Google, Amazon, and the like, and they're taking a lot of space. And so you're effectively underpinning, just like you might on an industrial shed, you need some tenants to come in and pay you your rent. You need to have these things locked away before you start building, so that you're not what we call spec building in the AI or in the data center space, where you got to be careful on the build it and they will come approach with any type of asset. But I think if you put the right guardrails in place, and your debt has a short enough tenor that you're not waiting 30 years to get repaid. It's 3-5 year money. It's amortizing through time. You've got the right tenants. You've got the right build approvals, and you're not speculating. I think it's a very good place to lend to. You just need to make sure that there's no speculation, or that the tenants are actually able to come in and deliver the rent, that they're capitalized enough to buy their chips and to buy their hardware to come in and fill your data center. And you want to make sure that they're in the right locations, so that if the tailwinds do come out of the market and there is therefore flight to quality, that you're not left in some of the remote areas, or that the areas that people have speculated on, rather than being sort of core locations that are needed as part of a network.
Yeah, fabulous response. Yeah, definitely you want to make sure it's appropriate lending for the long term. But for the short term, though, just a quick second question, though. It does seem like there's infinite demand for this stuff. AI is moving at the speed of light. They're pre-booking compute, etc. But can it all be met? You're in infrastructure. Can domestic and global infrastructure meet the current demand for gigawatt, given construction, water, energy, etc., etc.?
Yeah, the big risk is just the lead time for projects, and they're so contingent on a few things. You've got planning, permits, land acquisition on one hand. You've then got grid access, and that typically is the bottleneck for both electricity as well as you said, other resources, water, etc. The problem is you can't just switch these things on or off overnight. They're sort of like a big oil, bad analogy in my line of work, but a big oil tanker that takes a while in order to be able to move direction. And so you naturally will have pockets of speculation or overbuild and periods of underbuild, just in terms of when there are market reactions. But the big thing I'm focused on, whether you're lending or whether you're owning these assets, is the future battle, if you like, for access to energy. And it's particularly pronounced in the US, where you've basically had no new net generation come into the United States over the last 30 or 40 years, because roughly you've had the same amount of supply and demand for electricity. Now, if you were to look at somewhere like China, where that's gone 2-3-fold over that period of time, the risk that you've got is actually a social risk, which is that in a period of time where you've got big data centers that are fighting and able to pay for electricity, and there's only a finite amount of it, what's the implication on mums and dads in households, and what kind of regulatory penalties could come about, or unintended consequences that you need to try to factor in or price when you're investing in the space.
Excellent.
Well,
thanks.
Yeah, no, look, thanks very much. I think one of the issues which we're going to face is the cost of energy in Australia, and if AI data centers are one of those consumers, we're political pressure is going to mean that families come first, I think. So anyway, but look, thank you very much, Adam, Frank, Robert, for your participation over the last couple of days. It's been fascinating to think about the implications at this time. Of the rate environment that we're in and the opportunities that both private credit and infrastructure debt give rise to for investors. So thank you very much to those of you who've joined us. Thank you for your time. Let me just remind you of the other activities which we have coming up this year: the Advice in Action, Sydney Alternatives Week in September, Independent Thought and the MDA providers, and then tomorrow we're going to be picking up on this theme of global interest rates, and we're going to be looking at it not from an investment opportunity perspective, but from the portfolio construction perspective. So Kurum Jan from JANA will moderate a session with Cham De Silva from BetaShares and Tristan Bowman, portfolio manager specializing in fixed interest, from Cameron Harrison, a high net worth advice firm from Melbourne, as we'll be talking about their thinking as portfolio managers about the implications of our current rate environment and the way that's shaping how they think about fixed interest in the context of a total portfolio construction process. So, Robert, thank you for your time over the last 2 days. Frank and Adam, thank you for your time today. And we look forward to you all joining us again tomorrow. Thanks very much.
Thank you.